Check the mic and make sure it sound right.
And I do hope the mic does sound right. I'm going to cover a topic here revolving around BlackRock again and a move they made where BlackRock converted $3 billion in mutual funds managed by Rick Rieder into ETFs. That's a big move, converting mutual funds into ETFs. And you'll notice this is from a site for pensions and investments. And generally speaking, the majority of mutual funds that are created and owned are parts of retirement funds and retirement accounts. Generally speaking, when you look at your retirement options, they get you to choose from mutual funds. So I'm going to say a little bit about what the difference is, but I'm also going to cover this topic here a little bit as well, that BlackRock is making such a move. Now, this pensions and investments, if I wanted to read it further, it would cost me $49 to become a member of or subscriber or something. So that ain't going to happen. Nobody pays me to do these videos, but I did find another article talking about it at Verify on ETF trends. And it talks about where BlackRock converts its global allocation mutual fund pair to ETFs. And so it would pay for us to understand, with all this talk about exchange traded funds, and here comes XRP is going to become exchange traded funds approved by the SEC, spot ETFs, not the index ETFs that they had before, the futures ETFs, where they didn't even have to own the XRP. They could just bet on which way it was going to go. With the spot ETFs, they have to actually own the asset the same way mutual funds own the assets. And so when we say a spot ETF, we're talking about an exchange traded fund that actually owns the asset or assets that comprise that fund. And so BlackRock has converted their mutual fund to an ETF. And so what's the difference between that mutual fund and an exchange traded fund? Because my initial thought was all the people who were invested in these billions of dollars of worth of mutual funds have just had their type of investment altered, and it doesn't seem like they had anything to say about it. I don't like that. But more importantly, the fact that it's retirement funds that generally hold mutual funds and now ETFs, we're going to look at the pension assets that are available out there that could flood into the crypto market with exchange traded funds. It says this time one of the biggest in the industry is converting a pair of mutual funds to ETFs. BlackRock, with already over 100 active ETFs globally, the ETF provider continues to add to its ever expanding iShares ETF roster. These new ETFs build upon the $50 billion global allocation platform, and more specifically, the 8-year performance record and a combined $3 billion in assets under management of the previous mutual funds. What we're dealing with is the changing investment landscape. And as mentioned, more ETF providers have been making the switch from mutual funds to exchange traded funds, tapping into the latter's flexibility, tax efficiency, and low cost. Now, we won't be able to cover all those aspects. However, there are some primary differences that I would like to share with you, but more importantly, what it could mean for the influx of funds. So, when we look at mutual funds are considered open ended products. That means there's no limit to how many shares in a mutual fund that can be purchased. It's open ended. As long as there are people interested in the fund, they can sell the shares to the fund. And one of the other primary differences, aside from being open ended, is that the pricing. While the pricing fluctuates, but it's established at the end of each business day. And that's a distinct difference between an exchange traded fund. So, right here, it says the price of a mutual fund, also known as its net asset value, which is what it's worth minus fees. And that's where these financial institutions make their money by pooling everybody's money together and buying a bunch of securities and stocks and calling it a fund. And so it's like, I don't want to invest in the apples in the grocery store. I want to invest in the entire produce department and make that a fund. However, because I'm selective, I'm going to leave shallots and Brussels sprouts out. I don't want that part of my fund because I think it'll drag it down. But I'll put all the rest of the produce in it. In this case, a mutual fund is a collection of stocks, bonds, or other securities, just like grabbing all the produce and say, now I'm going to make all my money off of how well this produce department performs, not how much those apples perform. And then the price is set daily. And so the price fluctuates based on the value of the securities held by the portfolio at the end of the day. Note that mutual fund investors do not actually own securities. The securities in which the funds invest, they only own shares in the fund itself. So you don't own the apples, and you don't own the oranges, and you don't own the potatoes. You own their collective performance. Your share price or net asset value is determined by their performance, and it's open ended. There's not a set number of shares available. They're a cost effective way to invest. While individual purchase minimums may vary by the fund, many have even zero investment minimums. So like I mentioned in a prior video, if you wanted to buy stock and say Berkshire Hathaway, and at the time I put it up there, it was about 700 and some $1,000 a share. If you don't have 700 and some $1,000, you can't buy a share. But with a mutual fund, you can buy a share of every piece of produce in the produce department. In addition, minimums are often waived or reduced if investors buy a fund within a retirement account. And that's where we're going with that retirement account. And that's where most mutual funds exist. And BlackRock has taken upon itself to change mutual funds to exchange traded funds. Well, what about the exchange traded funds? Well, here are some basic differences to consider. Today, investors face what seems like an ever growing variety of investment choices, with new mutual funds and exchange traded funds continuing to arrive. They're different products with different experiences. As you consider ETFs and open ended mutual funds, notice open ended, it is important to recognize how the vehicle's similarities and differences may influence your investment experience. Buying and selling, pricing, disclosure, costs, holding period, return, and tax implications can all be different. Unlike the traditional open ended mutual fund, the price of an ETF is set throughout the day. So instead of waiting through the end of the day to set the price for a mutual fund share, the ETF share is set throughout the day. It's more volatile, it can fluctuate more greatly. And maybe that's why BlackRock is doing it. Higher demand from investors can result in the shares trading at a premium compared to the value of stocks that the ETFs hold. So, in other words, it doesn't necessarily have to add up to the prices that were all set for the produce. If the produce is so good that everybody wants it, you can set the price higher than what the produce costs by itself because they love the way you're managing your produce. You have great produce. Now, with the mutual fund, it's whatever they're worth minus fees, and that's the net asset value of the share. With the ETF, it could be in high demand or it can be in low demand. Your produce could suck, and people are only willing to pay you less than the general price for produce. I hope that helps understand it. Falling demand, there it is. Falling demand can cause the ETF to trade at a discount compared to the value of the ETF's holdings. If it's poor managers of the ETFs, people may want to say, I don't want to use Fidelity. No, I think I'll use JP Morgan. I think I'll use BlackRock. I'd rather go with Morgan Stanley. You follow me? And therefore, the fluctuations in the prices could change, just like the price changes throughout the day, compared to a mutual fund where it's only set once a day. This continuous pricing and the ability to place limit orders means the ETF's performance for any given time period is based largely on the market price return during the holding period, rather than on the ETF's net asset value, the value of the stocks held. So that's the big difference. Now, let's talk about the impact this kind of thing has by opening the doors for global pension assets. According to the Global Pension Assets Study of 2025 from Thinking Ahead Institute, pension assets climbed to record 58.5 trillion US dollars in 2024. It's probably more in 2025. The Global Pension Asset Study estimates global pension assets across 22 major pension markets. These geographies now stand at $58.5 trillion US in pension assets and account for 68% of the GDP of these economies. The study, conducted by WTW and the Thinking Ahead Institute since the 1990s, includes an analysis of the seven largest markets, the P7: Australia, Canada, Japan, Netherlands, Switzerland, UK, and the US, which comprise 91% of total pension assets. Tying it into our prior discussion about turning mutual funds that are primarily in retirement accounts into ETFs. I want to show you something that I did years ago in a video that will show why this is important today, but also why we can anticipate an influx of institutional monies coming into that market.
This article here, bank bail-ins, a $297 trillion monster hiding in your closet. I'm going to take an aside here. The Inflation Recovery Act. I think not only are they coming at your bank, you see this up a 401k rollover menu up here, this thing up here. Take the acronym for Inflation Recovery Act, and what do you end up with? You end up with IRA, Individual Retirement Account. They're coming after those too. They're coming after your money, folks. And the reason being is they want to crush the little fella, and you will not resist a new monetary system. When that new monetary system occurs, it's going to be digital money. Well, then not only do they know who you are, they're going to know where you spend it. And because it's programmable money, they're going to be able to turn your money on or turn your money off or limit your money without even asking you. And when it gets to the point of negative interest, you're not going to be able to pay your negative interest bill. It'll be the same as paying your monthly fees if you have monthly fees on your bank account, monthly fees if your balance falls below a certain amount, and so on and so forth. That's where it's going, folks.
That was taken from a September 2022 video anticipating these type of developments, and this type of move is heading in that direction because that's trillions of dollars sitting there that they can churn and burn and earn their fees by turning it into ETFs without them absorbing the risk if it fails. And if you recall, I did a video back when the Bitcoin ETF came out, and it posed the question, can a Bitcoin ETF fail? The answer, if you'll watch the video, will certainly turn out to be yes. And so, can your mutual funds fail? It's highly unlikely because they'll rebalance those mutual funds to meet their investment objectives that they told you about in the prospectus. And then they'll set the net asset value. Can the net asset value go down? Yes. Can it go up? Yes. Same for the ETFs. However, with the ETFs, you're assuming a more equity risk than you are with the mutual funds. And therefore, if the asset that the ETF is based upon fails, guess what happens to your ETF? It fails too. And since there's so much, 68% of GDP, since there's so much money in these retirement accounts and they've eaten everybody up with inflation, where you don't really have the ability like you had before to save money and invest money, you're relying on your retirement account to be there for you when you retire. Did I say inflation is eating your money up? Did I say in that video, Inflation Recovery Act? They're coming after the pensions, people. They're coming after the retirement accounts. They're turning the mutual funds and retirement accounts into exchange traded funds. so that they can continue to earn their money, continue to take your money, and continue to control our money. Money doesn't just disappear in the markets. And when you get an ETF offering to you, you're paying the issuer of that ETF, of that exchange traded fund. But you're also paying costs. As you can see here, open ended mutual funds, exchange traded funds. With the mutual funds, there's no fee trading costs for a no load fund when bought directly through a fund company. Now let's talk about the ETF. While many ETFs are sold commission free, brokers may charge a commission plus the difference between the bid and the asking prices, the spread, on each buy and sell order. So not only are they offering you that package of equity, that package of stocks that you don't even own the equity, they do, but you're paying for it. And then you're paying the fees for it. And if it fails, you lose the money for it because you already gave your money to them and they charge you fees. So in the end, when you turn around and look at your individual retirement account, you'll see the performance is dismal. But they tell you up front that you are assuming a risk. They're devils. Remember, when it comes to crypto, 99% are going to fail. I'm DK Will. This is DK Will Talk About It. And I've talked about it. Have a wonderful day.
Check the mic and make sure it sound right.